You remember in the previous video on the trick to spotting market waves early, I spoke about how the market always reflects back to us what we believe about it, how it reveals its rhythm to anyone who can remain objective long enough to see it. Today, we're going to get into something even more essential, something that separates traders who evolve psychologically from those who stay trapped in cycles of frustration. Why do most traders fail at trend following? You'd think it's the easiest approach of all. The market is going up, so you buy. The market is going down, so you sell short. Yet if it were that simple, the trading world wouldn't be filled with stories of blown accounts and shattered confidence. Let me ask you something. How many times have you watched a stock climb and thought, it's gone too far, I can't buy it now? And then that same stock doubles again while you sit frozen? That hesitation is the first reason most fail at trend following. They can't bring themselves to buy strength because emotionally they associate high with danger. They think buying strong momentum's reckless, not realizing that the market moves based on the collective beliefs of others, not personal logic. They want certainty, a bargain, something that feels safe. But in trading, the need for comfort is what destroys performance. The professional doesn't buy cheap. He aligns with strength because he understands that the market's strength represents conviction. Another reason is that traders can't let their winners breathe. A person will cut profits short out of fear of giving back what's already earned. He sees an open gain, and the moment the market pulls back slightly, he exits, congratulating himself for locking in profit. But the real opportunity was in letting the market unfold without interference. The market rewards emotional neutrality, the ability to stay in harmony with the flow, not the impulse to protect the ego. How many times have you looked back and realized the big move was the one you abandoned too early? You see, most traders seek stimulation, not growth. They crave the emotional high of being right now, not the inner calm that allows capital to compound over time. They mistake activity for progress. Trend following, on the other hand, demands inner balance, patience, quiet, and trust. That's why so many fail. It's not about indicators or systems. It's about mastering the inner dialogue that says, do something. Tell me honestly, can you sit still while the market works for you without second-guessing every tick? I've said many times that trading success is not a function of intellect, but of mindset. The market doesn't pay for brilliance. It pays for consistency of thought and emotional control. Most trend followers fail because they don't trust themselves. They enter a trade but then doubt their plan the moment the market moves against them. They confuse a normal fluctuation with danger. Yet every major move tests conviction before rewarding it. If you expect the market to move smoothly in your favor, you're not trading reality. You're trading fantasy. And then there's leverage. A trader sees a trend, piles in too large, and when the market retraces, he's forced out. He had the right idea, but the wrong emotional tolerance. And you know how many traders blow up not because they were wrong, but because they couldn't handle being temporarily uncomfortable. It's not the trend that defeats them. It's the emotional pressure created by overexposure. Now think about what we discussed about catching those waves early. Spotting the opportunity is one skill, but living through it, riding it without emotional sabotage, that's the art. That's where trend following transforms from a method into a mirror. Because what use is seeing potential if you panic halfway through. The connection is clear. Identifying the trend is the technical part. Holding it is the psychological part, and most fail at the psychological part. Why else do they fail? Impatience. A trader begins with a plan, but the moment the market doesn't respond fast enough, he tinkers. He adjusts his system, adds filters, looks for new secrets. But the market doesn't respond to anxiety. It reflects it. The principles of movement haven't changed in 100 years. Price trends because human emotion trends. If you don't trust your process, you'll always chase new noise. And the need for certainty. That's the trap. Traders want to know what will happen. They seek control where none exists. But the market offers only probabilities. Your edge lies in accepting uncertainty, in understanding that not knowing is the natural state of the game. The irony is that when you truly accept uncertainty, you open the door to consistent results. Another reason most fail is that they mistake trend following for prediction. They think they must forecast the future. But trading isn't about being right. It's about aligning with what is. Prediction is ego-driven. Following is surrendering to what the market communicates. Too many traders ruin themselves trying to outsmart a process that never needed their intellect, only their trust. And then there's anticipation, the obsession with calling tops and bottoms. Every failed trader has fallen for it. They think the move has gone too far. Yet the market can move far beyond the limits of imagination. Tops and bottoms are illusions seen only in hindsight. Anticipation is the enemy of flow. The skilled trader waits for confirmation, for evidence that the collective belief has shifted, not before. But the novice thinks waiting is missing out, when in truth, it's protection from self-sabotage. The beauty of following is that it removes the need to know. You simply respond, you align, you participate without resistance. Discipline then becomes the cornerstone. Without it, trend following disintegrates. A trader sets a stop, but when price nears it, he moves it, trying to avoid discomfort. Then the market hits harder, and the small loss becomes large. The idea was right, but the mind was weak. Have you ever broken your own rule and regretted it? That's not a market mistake. That's a mindset mistake. Trend following is elegantly simple, but emotionally complex. It demands 3 traits: patience to wait, courage to act despite fear, and discipline to stay through uncertainty until the market proves otherwise. Most traders fail because they lack one or all of these. They want the profits without the process, the reward without risk, the outcome without the surrender. But the market doesn't bend to our emotional comfort. Human nature seeks ease, but trading requires embracing discomfort. It feels good to take quick profits. It feels safe to widen a stop. But those are comfort decisions, not growth decisions. The truth is, your worst trades probably felt comfortable at the time. The first real barrier to success in trend following is the belief that you must buy low and sell high. The conditioning of a lifetime. It sounds logical, even smart. But in markets, that thinking kills more accounts than anything else. The crowd buys when it feels comfortable, when prices are down, when it looks cheap. Yet cheap often means weak. Price reflects belief, not value. And still, traders repeat the cycle. They see strength, call it expensive, and wait for the better entry that never comes. Or worse, they enter late, driven by the fear of missing out, just as the move ends. That hesitation, that internal conflict between fear and greed, is what sabotages them. Strong trends are fueled by collective conviction. Institutions accumulate over time, and the process itself drives price higher. Those who wait for comfort never participate. They watch from the sidelines, convinced prices are irrational, not realizing that too high can become still early when emotion meets momentum. The truth is, the strongest opportunities always feel the most uncomfortable. That's the paradox most traders can't reconcile. The very behavior that feels safe is what guarantees failure. There's also a deep psychological illusion at work. When a market is falling, traders feel safer buying because it feels like the risk is smaller. They believe the worst must be over simply because price is lower. But markets don't operate on comfort. They operate on collective belief and momentum. A falling price is a reflection of imbalance, of overwhelming selling pressure, of the collective conviction that value lies lower. To buy into that weakness is to step into emotional chaos and call it logic. It feels safe only because it matches the comfort of denial. The market doesn't care about what feels safe. It rewards alignment with flow. When a market is rising into new highs, most traders feel nervous. They imagine they're the last fool to buy. They see price discovery as danger instead of opportunity. Yet that discomfort is the price of participation in expansion. It takes psychological courage to act when your emotions scream too high, because that's precisely where the path of least resistance lies. That courage, to align with movement rather than fight it, separates traders who grow from those who protect their limitations. Ask yourself, when was the last time you bought a market at an all-time high and held it without hesitation? Most can't recall because fear of being wrong outweighed the potential of being free. The market never rewards hesitation. When price is making new highs, it's not random. It's evidence. It's the only objective fact you have. Price strength is not something to fear. It's information about where belief is concentrated. Ignoring that because it doesn't fit your mental model of cheap is rejecting truth in favor of comfort. Most traders never recondition their thinking to see strength as confirmation rather than caution. That's why they fail. Then there's the ego, the need to be right. Many traders want to feel clever, to be the one who called the bottom. They crave the validation of being first rather than the success of being consistent. But following strength isn't about intellect, it's about emotional neutrality, about surrendering to what the market already knows. The market's flow tells you where collective belief and capital are moving. You don't have to outthink it, you just have to stop fighting it. Yet most traders would rather defend their self-image than earn real profits. They confuse being right in theory with being effective in practice. Another illusion is underestimating how far trends can go. Traders look at a chart, see a doubling, and assume it's overextended, as if the market owes them a limit. But the market has no limits, only participants' beliefs. Price can multiply 5, 10, 20 times when conviction compounds. What seems excessive at first is often just the beginning. If you judge the present through the lens of the past, you'll always think it's too late. That's why traders obsessed with cheap prices stay perpetually underexposed to opportunity. Now think about how this connects to mindset. A trader who insists on buying cheap is operating from scarcity. He's afraid to risk believing in growth. He's not playing to win. He's playing not to lose. His entire frame of reference is defensive. But markets reward expansion, not contraction. To follow trends effectively, you must expand your sense of possibility. You must allow yourself to believe that the market can carry your trade far beyond what feels reasonable. You must abandon the illusion of safety in cheapness and embrace the discomfort of strength. That shift in consciousness, from scarcity to abundance, from fear to trust, is what divides mediocrity from mastery. And this brings us back to the chart, the mirror of all market psychology. The chart doesn't lie. When price prints higher highs and higher lows, when momentum builds and volume confirms conviction, That's objective truth. The market is communicating that belief is expanding. To argue with that is to argue with reality. The market doesn't pay you for intellectual debate, it pays you for emotional discipline. Following the chart means trusting objective data over subjective emotion. Are you willing to trust evidence over instinct? That's the defining question every trader must answer. Ironically, the same traders who fear buying strength have no issue holding weakness. They buy a declining stock because it's cheap, and when it keeps falling, they hold tighter, refusing to accept loss. They keep averaging down, clinging to hope disguised as strategy. Yet when they buy strength and the market pulls back even slightly, they panic, rushing to sell. They nurture losers and smother winners. This is not a market problem. It's a mindset problem. Human nature inverts the formula for success and calls it prudence. This is why the fear of strength and obsession with bargains destroy so many. The instinct that feels safe is the very one that feeds failure. They cling to comfort, unaware that profits live in discomfort. The big money is made by aligning with strength, not by chasing weakness. Until a trader reprograms this instinct, until buying strength feels safer than buying weakness, trend following will always remain out of reach. Another critical reason traders fail is the compulsive urge to cut profits short. The moment they see a gain, they shift from objective participant to emotional protector. Instead of letting the trade unfold, they grab at the first retracement, mistaking the illusion of control for safety. They call it locking in profits, but in truth, they're locking out potential. The market doesn't pay for fast gratification. It rewards alignment with long-term flow. Think about your own experience. How many times have you entered correctly, felt the surge of being right, then exited at the first dip, only to watch the move continue for weeks or months? You told yourself you'd re-enter, but hesitation paralyzed you. That single decision to avoid discomfort cost you multiples of your initial gain. The big money doesn't come from reacting to every fluctuation. It comes from trusting the process long enough to let probability unfold. Traders cut profits short out of fear. The fear of losing what they've gained. The possibility of loss carries more emotional weight than the excitement of future gain. That's human nature. But in trading, that instinct is inverted. The willingness to let go of immediate safety is what opens the door to exponential reward. The market's greatest gifts come to those who can hold through temporary discomfort without needing to control the outcome. Impatience is another form of fear. Traders crave results now. If the market doesn't move quickly, they get restless, chasing new trades. But trends move at their own pace. They are living systems, not events to be scheduled. The trader who can wait becomes the one who catches the move that others abandoned out of boredom. And then there's ego again. The obsession with being right often. Many traders equate frequent wins with success, but consistency isn't about how often you win. It's about how you manage your winners. You can be right 30% of the time and still grow exponentially if you let those winners run. But the ego prefers comfort, the illusion of being right frequently rather than being profitable meaningfully. Which would you rather have? A string of small wins that feed your pride, or a handful of big wins that change your life? Another trap, doubt. Traders don't trust the trend once they're in it. Every small fluctuation becomes a reason to exit. But trends breathe. They expand and contract. If you can't emotionally tolerate normal pullbacks, you'll always exit before the payoff. Following the trend means accepting uncertainty as part of the process. Your best trades will almost always feel uncomfortable before they pay. Cutting profits short also reveals poor planning. A trader who hasn't defined how to manage success will always default to fear. Without structure, uncertainty feels unbearable, and panic takes over. Discipline, not emotion, must be the decision maker. It's discipline that keeps you in the trend when your instincts beg you to run. And finally, this circles back to mindset again. Scarcity versus abundance. A trader who thinks small settles for crumbs because he doesn't trust the market or himself to deliver more. The abundant thinker holds steady, knowing the market is capable of producing moves that defy logic. Institutions operate this way, not because they want to, but because their size requires it. They move in trends, hold for months, and in doing so create the very waves that others fear to ride. If you align yourself with institutional movement, you must be willing to stay as long as the collective conviction remains. Selling too soon means abandoning the very part of the move that large capital is driving. Why would you let them move price without your participation? When you study charts of great market winners, you always see the same psychological pattern repeating itself. Price breaks out, pauses, consolidates, tests conviction, then continues, often through multiple phases. The early participants who couldn't emotionally tolerate the first pullback exited, missing the true payoff. The few who stayed aligned through uncertainty captured life-changing results. History repeats because psychology repeats. Most traders never learn emotional endurance. Will you? This is where trend following diverges sharply from prediction. You don't have to know where the market will peak. You don't need to define the endpoint. Your job is to stay aligned with flow until the market itself invalidates your premise. Yet most traders can't emotionally tolerate that uncertainty, so they exit long before the market gives them a reason. That inability to coexist with the unknown is why they fail. Most traders fail at trend following because they don't actually seek wealth. They seek stimulation. It might sound harsh, but it's true. They enter the market dreaming of freedom. But what they're really chasing is emotional excitement. They crave the rush of being active, the dopamine of numbers flickering on a screen, the feeling of control that comes from doing something. But the market doesn't reward activity. It rewards alignment. And alignment requires patience, which to the undisciplined mind feels intolerably dull. Following a trend often means doing nothing for long stretches, days, weeks, sometimes months. And for most, that's psychologically unbearable. They would rather stay busy, trade constantly, take small wins, feel engaged, than sit quietly while their capital compounds invisibly. Have you noticed how traders brag about how often they trade instead of how well they compound? They talk about the number of entries, exits, and setups as if frequency were proof of professionalism. But professionalism in trading is the art of restraint. Less truly is more. The fewer decisions you make under emotional pressure, the greater your edge becomes. The amateurs hide behind activity because stillness forces them to face their inner noise. The tape acts as a mirror, reflecting back their impatience. They can't bear that reflection, so they keep moving. The market knows this. It's designed to exploit the majority's psychological weaknesses. It tempts traders with constant movement, small fluctuations masquerading as opportunity. The amateur takes the bait, chasing every wiggle. The professional ignores them, waiting for clarity. That distinction, reaction versus restraint, is the dividing line between mediocrity and mastery. Ask yourself, do you ever feel the need to trade simply because you haven't taken a position recently? That compulsion is not strategy. It's addiction. The action seeker is emotionally attached to novelty. He loves the hunt more than the harvest. He flips through tickers, chasing rumors and next big things. Once in a trade, he grows restless, already scanning for the next thrill. He calls it diversification, but in truth, it's diffusion, spreading capital thin across meaningless motion. Real diversification in trading isn't about being in many places. It's about being deeply aligned with the few real opportunities that matter. The action-driven trader is scattered, uncommitted, and emotionally dependent on movement. He's in love with the process, not the result. And here's the cruel trick. The market rewards that behavior just enough to keep him trapped. It offers small, frequent wins, enough to reinforce the illusion of skill. But those wins never accumulate. They're consumed by costs, by friction, by inevitable drawdowns. Meanwhile, the trader who placed a few calculated bets and sat still sees his capital multiply quietly. The action chaser doesn't notice. He's too busy chasing his next emotional high. This is where psychology and money mindset converge. A trader addicted to action isn't truly building wealth. He's feeding an emotional habit. His focus isn't compounding, it's stimulation. The same impulse that drives gamblers and thrill seekers drives him, the pursuit of intensity over longevity. But trading is not supposed to be thrilling. It's supposed to be structured, deliberate, and boringly consistent. If your trading feels exciting, it's likely fueled by emotional risk rather than statistical edge. Have you ever ended a trading day feeling drained, not because of financial loss, but from the sheer compulsion to keep trading? That's not flow. That's fatigue, born from emotional overexertion. And it's lethal to trend following. Now let's talk about boredom, the hidden test most traders fail. Following a trend requires enduring periods of stillness, where nothing appears to happen. Price consolidates, volume fades, volatility contracts. To the undisciplined mind, this looks like wasted opportunity. The impatient trader exits, convinced he can redeploy capital elsewhere more efficiently. But that quiet, uneventful phase is often the necessary pause before the next leg of expansion. The trader who holds through boredom captures it. The one who bails misses it. The ability to remain still during stagnation is one of the rarest forms of mental strength. That's why so few ever experience the full potential of a trend. Most traders abandon positions during consolidation phases, not because of logic, but because of discomfort. Watching nothing happen feels intolerable, while other names flash green across the screen. They exit to chase movement elsewhere, and by the time their original position breaks out, they're already trapped in a new lower quality setup. The market punishes their restlessness by rewarding those who stayed patient. Most traders unconsciously measure success in short intervals, daily or weekly outcomes. They want progress that feels tangible and immediate. That's not trading. That's employment conditioning. Employees expect steady paychecks. Traders must accept irregular distributions of profit. You might make nothing for months, then earn more in one sustained move than in half a year of churning. If you can't emotionally handle that uneven rhythm, you'll sabotage yourself before your edge can express itself. The obsession with daily gains is the illusion that keeps traders acting like workers rather than creators of capital. Trading isn't a job, it's an arena of probability and patience. True success often looks like doing less. You enter a position, define your risk, and then wait. For long stretches, your best decision is inaction. To the action-oriented trader, that feels unbearable, even lazy. But it's precisely that restraint, that willingness to do nothing, that generates wealth. The hardest work in trading is often the discipline of stillness, resisting the compulsion to intervene? Can you sit in silence while your position matures? Can you let time and probability do their work without trying to control the outcome? That's the real psychological test. Think back to the earlier principle. Spotting the wave early means nothing if you can't ride it. Riding the wave requires trust and endurance through quiet, uncertain phases. The impatient trader paddles into every ripple, exhausting himself before the real swell arrives. The focused trader waits, commits, and rides one major wave all the way through. That's the core of alignment. Participation without interference. And finally, understand this: activity costs money. Every trade carries friction, spreads, slippage, commissions, and emotional fatigue. The more you trade, the more those invisible costs erode your edge. The fewer, more intentional trades you make, the more capital you retain. The action addict ignores this math, mistaking busyness for progress. He burns through time, energy, and equity, calling it experience, when in truth, he's avoiding discipline. By the time he realizes the truth, the trend he was supposed to be part of has already moved on without him. If you truly want to understand why most traders fail at trend following, look not at their charts. Look at their journals.